Most people have heard of stocks, most people have heard of bonds, but here's what shocks me. The majority of people investing their own money right now have no idea what the difference actually is. They're putting their savings, their retirement, their future into things they can't even explain. And that is a dangerous game. Today, we're fixing that. By the end of this video, you'll know exactly what stocks and bonds are, which one is right for you right now, and why getting this wrong could cost you years of financial progress. Let's get into it. Section 1. What is a stock? Let's start with stocks. When a company wants to raise money, maybe to expand, hire more people, or build a new product, they can sell little pieces of ownership in the company to the public. Those pieces are called shares or stocks. When you buy a stock, you own a tiny slice of that company. If the company does well, your slice becomes more valuable. If it struggles, your slice loses value. It's that simple, and that nerve-wracking. Think about it this way. Imagine your friend opens a bakery and asks you to invest £1,000 for a 10% stake. If the bakery blows up and is worth £20,000 next year, your stake is now worth £2,000. You've doubled your money. But if the bakery fails, your £1,000 is gone. That's stocks in a nutshell. High potential, high risk, no guarantees. The S&P 500, which tracks the 500 biggest companies in America, has historically returned around 10% per year on average. That sounds great, but in 2022 alone, it dropped nearly 20%. That's why so many people panic sell at exactly the wrong moment and lock in their losses. Section 2. What is a bond? Now, bonds. This is where most people's eyes glaze over, and honestly, that's fair. Nobody talks about bonds at the dinner table, but they absolutely should. When a government or a company needs money, they have two choices: sell shares of ownership, that's stocks, or borrow money. When they borrow from investors like you, they issue a bond. It's essentially an IOU with a promise attached. Here's how it works. You lend, say, $1,000 to the U.S. government by buying a treasury bond. They promise to pay you a fixed interest rate, let's say 4.5%, every year for 10 years. Then, at the end, you get your $1,000 back. No drama, no surprises. Just steady, predictable income. Bonds don't make you rich overnight, but they also don't wipe you out overnight. That's the trade-off. In the UK, government bonds are called gilts. In the US, they're called treasuries. Companies also issue bonds called corporate bonds, which pay higher interest because they carry more risk than government bonds. If the company goes bankrupt, you might not get your money back. So let's break down the real differences, because this is where it gets important for your actual money decisions. When you buy a stock, you're an owner. When you buy a bond, you're a lender. That one distinction changes everything. As a stock owner, you have upside potential with no ceiling, but you also have no safety net. As a bond lender, you have a contract, a legal promise to be paid back. That's a completely different risk profile. Stocks are volatile, bonds are boring, and sometimes boring is exactly what your portfolio needs. Here's another key difference: dividends versus interest. Some stocks pay dividends, which are a share of the company's profits. These can be stopped anytime. Bonds pay interest on a fixed schedule. It's written into the contract. Much more reliable, but much lower returns. And in a worst-case scenario, if a company goes bust, bondholders get paid first. Shareholders, they're last in the queue. You could end up with absolutely nothing. Section 4. The relatable pain point. Here's the part that I think really hits home. Most people in their 20s and 30s are told, just invest in stocks. You're young, you have time. And that's largely good advice when markets are going up. But nobody prepares you for the gut punch of watching your account drop 30% in a bear market. Nobody tells you how hard it is to not sell when you see your savings slashed in half. Most people can't handle it. They sell at the bottom, lock in the losses, and swear off investing forever. And that's the real tragedy. On the flip side, people in their 50s and 60s who have everything in stocks and suddenly need that money, they're at the mercy of whatever the market decides to do that year. Retire in 2008, retire in 2020. The timing of a market crash can completely derail a retirement that took 30 years to build. That's why bonds exist in your portfolio, not to make you rich, to protect what you've already built. So now the question everyone actually wants answered, which one should you have in your portfolio? The honest answer is probably both, in different proportions depending on your age, your goals, and your ability to stomach risk. A common rule of thumb, and I want to be clear, this is a starting point, not gospel, is to subtract your age from 110. The result is the percentage of your portfolio in stocks. So if you're 30, that's roughly 80% stocks, 20% bonds. If you're 60, it flips closer to 50-50. The logic is simple. When you're young, you have decades to recover from a market crash. You can afford the volatility of stocks. As you get older and closer to needing the money, you shift toward bonds, stability over growth. But here's what most beginners miss. It's not about picking one and ignoring the other. It's about using both as tools for different jobs. Stocks grow your wealth. Bonds protect it. You need both. The worst portfolio is 100% stocks in a panic or 100% bonds in your 20s, collecting 4% while inflation quietly eats your future. Here's what I want you to do right now. Go check your investment account, whether that's a 401k, an ISA, a Roth IRA, whatever you have, and look at how it's split between stocks and bonds. Does it match your age and your goals? If not, that's your homework this week. Drop in the comments, are you currently team stocks, team bonds, or a mix? Let's talk about it. I read every single comment. If this video helped clarify something that's been fuzzy for years, do me a favor and share it with one person who needs to hear it. That's how we build a generation that actually understands their own money. Subscribe for more no-nonsense finance content, and I'll see you in the next one.